Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filings. Today we're diving into Reed's Incorporated's latest report, and it's a real mixed bag. It's like their ginger beer flavors, some strong points and some things that leave a bit of a bad aftertaste. So, what's the story? Reed's is trying to navigate a changing beverage market with some debt restructuring and a change of control. We have a new majority owner, so let's see how they're doing. First, let's get a taste of the market they're playing in. Reed's operates in the carbonated soft drink industry, which is gigantic. That said, within the soda market, consumers are reaching for better-for-you products, and Reed's is going in that direction. Consumers are shifting to things that are natural, have less sugar, and are plant-based. Reed's has a good opportunity here. This trend is also for premium beverages, so Reed's is positioned to capitalize on some great trends. Jumping to the financials, let's find out what's really going on. Okay, here's the important stuff. Gross billing, that's like total sales before discounts, was around 44 million. If we compare that to the prior year, it's about 50 million. That means there has been a 13% decrease, which isn't great. They're giving out more discounts to generate sales, but it doesn't seem to be working out. Promotional allowances are what Reed's gives to stores to sell their products. That was at around 6 million. This may indicate there is increased competition. Cost of goods sold decreased 17%, good, but the percentage of sales remains high, indicating potential inefficiencies compared to prior years. So they're making stuff for less money, but it's still costing them a lot to produce. It's also important to notice what Reed's is not, a large accelerated filer. That means they get some reporting exemptions. Here the filing also indicates that Reed's is a non-accelerated filer and a smaller reporting company. It means they don't have to jump through all the hoops that bigger companies do. This means that they aren't held to the same standards as other larger and more established companies. Total operating expenses were fairly flat, around 19 million. So while costs of producing their product went down, their costs of operating went up. This leads to a loss from operations of 8.1 million, and even though that sounds awful, it's better than last year's 9.4 million. Net loss per share is 1.2439 cents per share last year, which is nice. This was achieved because the amount of shares increased a lot. They had a lot more shares, 8 million compared to 3 million. So existing investors got diluted a lot for a better looking net loss per share. Now, some other important factors. Reed's admits that there are supply chain issues and that raw materials, logistics, and labor are getting more expensive. This means they need to be careful managing these costs. Reed's also talks about reputational damage as a risk. If people start thinking their drinks aren't good or safe, that could hurt sales. It's important to note they call that out specifically. There's also the risk of someone stealing their recipes. Reed's recipes aren't patented, so they rely on keeping things secret. They even reiterate it. It means if a competitor reverse engineers their ginger brewing process, they're toast. Taxes, of course, are always a threat. If places start taxing sugary drinks or even artificial sweeteners, it could be another big problem. Now, there is the risk of a cyber attack. That's always a risk for companies like Reed's, but they have a cybersecurity vendor, so they're taking it seriously. It's worth mentioning the person in charge of keeping it all together is their chief financial officer. And here's an odd thing, I have something called a preemptive right. If Reed's wants to issue new stock, de can buy enough to keep their ownership percentage the same. This could discourage other investors because de can muscle in. eBay Day adjustments was $9 million this year versus almost $12 million. The adjustments include stock option, interest, tax, and inventory write-offs, and non-recurring fees, which the company had few of this year compared to last year. Keep this in mind when evaluating management's performance. Modified EBITDA looks like a loss of 4 million. Last year's same time, it was also a loss 3.6. I should point out Reed's is a smaller reporting company, so they get a lot of exemptions, which means we are missing some data and we have to really look at the numbers carefully to get a good assessment of their state. So what do we make of all this? It's a company in transition. Cost of input goods went down, their sales didn't follow, but they are making some changes and are trying to get innovative to get in front of the growing trends in the market. A smaller reporting company means we need to take things with a grain of salt and do extra work to figure out what the company is doing since the financial records are harder to track. If you're an investor, you should keep a close eye and carefully reevaluate your position in 12 months. So thank you so much for watching, everyone. If you enjoyed the video, please like, comment, and subscribe.